My name's Dan Bridgeland. I'm the Care Super Financial Advice Manager, and I'm so glad to be presenting some strategies you can use to build your wealth for retirement. I've been a financial planner for about 9 years. I hold a master's degree in financial planning. I've been with Care Super for over 5 years, having started my career with Care Super in the Sydney office, and I'm now based in Melbourne. During this presentation, I'm providing general information only, and that means I'm not taking into account your personal circumstances, your finances, or your objectives. You should consider what's appropriate for you, read the PDS, and ideally seek out skilled and qualified financial advice if needed. Basically, your superannuation equals the contributions that have been made so far, whether they be employer contributions or additional contributions you've made. It includes the investment earnings, so the way that your super is invested, hopefully these are positive returns, but sometimes negative depending on how it's structured. And then you'll have fees, taxes, and possibly insurance premiums, and that's what will give you what you will have when you reach retirement. And I'd like you to ask yourself, have you ever looked at the amount of insurance that you need to have for yourself or for your family? This is actual feedback from a real member, Aaron, and he's given us approval to use this. Aaron was 38. He had a young family and a wife, and Aaron had to go into open heart surgery. It was unexpected, and what that meant was that Aaron had to take 5 months off work, and it was not planned for. When Aaron joined Care Super, he spoke to one of our limited advice financial planners because this is a service you can access at no additional cost. Our limited advisors actually did a review of Aaron's insurances, and we made a recommendation for Aaron to put some specific cover in place to protect him in the event that he couldn't work. When Aaron was diagnosed with this issue, it meant that he was able to take time off work and his income protection policy kicked in, meaning that Aaron was able to put food on the table and take time off to recover and make sure his family and himself was okay. I'd like you to think about your situation and your own family if you have one. What would happen to you or your spouse if you couldn't work in the short term? Now consider your situation. You may have income coming in, and that income may be used to pay your bills, pay your mortgage if you have one, pay off your loans. We may need to pay our kids' education bills, all sorts of things. If we don't have money coming in the short term, it can create some significant issues. In an ideal scenario, a lot of us might try to save up a bit of a cash reserve so we've got cash there to support us in the event of something happening. But what happens if you can't work longer than the cash reserve that you've got lasts? What happens if you couldn't work in Aaron's situation for 5 months? What if you couldn't go back to work for potentially 2 years? Do you have mechanisms in place that will allow you to cover your expenses and keep income coming in? Or would you potentially have to reduce costs? Would you have to sell your house? Who knows what that could potentially mean? There are things that you can put in place to protect your income if you can't work in the short term due to illness or injury. And this is what we call income protection insurance. Income protection can be set up to pay you a percentage of your pre-injury or pre-health issue income, and it can be paid to you on an ongoing basis based off certain parameters. I'll give you an example of mine. So I have an income protection policy in place because if I can't work, I still have to pay my mortgage and pay my bills. I've set my policy up so that if I can't work, it will kick in after 30 days. Most income protection policies will pay you in arrears, meaning it will actually pay me after 2 months. So it will kick in at month 1, but I won't get paid until month 2. So I've got to have enough money to cover my costs for the first 2 months. I then have a benefit period of up to 2 years, meaning that if I can't work due to illness or injury, I'll be paid from 2 months out to 2 years. I could choose to have a longer benefit period. I could choose to have a benefit period that pays for up to 5 years. Some policies will allow you to receive a benefit or payment up to age 65. But that means my premiums will be more expensive. And you need to weigh it all up. Yes, it's great to have all this cover, but you've then got to pay for it. So you've got to work out the benefit of having the cover versus the cost. The next thing you need to think about is what happens to you if you can't work in the longer term. What happens if you have a serious injury or illness and you are permanently disabled and can never go back to work? You may be eligible for a disability support pension, but on top of that, what are you going to do to cover other costs? If I was to become permanently disabled, I probably would want to try and pay off my mortgage as well as any other costs or expenses I might have. I might need a lump sum to make adjustments to the home. There might be a range of different things that I need to do. Next thing we need to consider is what happens if we pass away? Who do we need to provide for? Now, let's go back to Aaron's situation. If Aaron was to pass away, he has 3 children. He might want to provide for their education. He might want to have funds available to pay off the mortgage. He might want to have some funds to provide for his spouse to take some time off to look after the kids. There's a range of different things that you might want to consider. In my case, I don't have children. I don't actually have anybody else that I need to provide for. So for me, I'm actually not worried about what happens to me when I pass away. So I've chosen to try and reduce my cover, but it's about identifying what's important or appropriate to you and your situation. Thank you for watching. We hope that you've learned something from this video, and we also hope that it's actually made you think about your goals, and perhaps you even have more questions that are specific to your own situation and circumstances. We can help you find the answers. There are 2 main options when it comes to supporting you with providing financial advice at CareSuper. As a CareSuper member, you have access to financial advice over the phone as part of your membership. This level of advice provides limited information and support on your super account relating to levels of insurance cover, weighing up your investment options, making additional contributions to your superannuation, and how you're tracking and how much you can afford to spend in retirement. If your concerns are broader than your superannuation and your financial situation is more complex, you may benefit from meeting with a comprehensive financial planner. Our planners consider your whole situation, including any assets you have outside of super, your debts, and your financial goals. This level of advice is provided on a fee-for-service basis. Your first meeting with a comprehensive advisor is at no additional cost. We'll sit down with you for an hour and a half where we ask you lots of questions and get to know you, understand your current situation, where you are, and where you want to get to. At the end of that meeting, if we believe we can put you in a better position, we'll offer you advice and we'll provide you a quote based on the amount of time it's going to take us to go back and do our research. So you're going to know what the fees will be up front. Thank you once again. We look forward to connecting with you either through our ongoing education program of webinars or events, or by meeting with you to discuss your personal financial goals.